Hi viewers, hi learners. You are trying to catch me withdrawing money from an ATM. That is what most of us are after, isn't it? An entrepreneur starts an enterprise with the purpose of making a profit. Today I wanted to withdraw money from the ATM, but it seems my cash flow focus was wrong.
Oh, and if you're wondering what a cash flow focus is, it is the topic of our lesson today. Lesson 3 in our 5-part series of Grade 12 Entrepreneurship learners. We are going to discuss how to present financial data such as cash flow focus with the use of graphs and tables. Here we are. We have 3 learning objectives for this lesson. Learners should be able to use a formula for calculating profit, explain the concept of cash flow and the purpose of focusing cash flow, and use graphs and tables to present financial data including the cash flow focused. Let's get started.
You have learned about profit making since grade 8 entrepreneurship. I am sure that you can still remember what profit is, right? Profit is the money that is left after you have paid for all your expenses.
But the entrepreneur does not have to wait until the end of the month to count his money in order to know how much profit to expect. We use a formula to calculate anticipated profit. The formula is income minus expenses. Let's use this formula to calculate the profit of an enterprise. We will call it Sweet Tooth Enterprise. To get the profit, we deduct the expenses of Sweet Tooth Enterprise from its income. The total income for Sweet Tooth Enterprise was $242,020, and the total expenses was $26,850. Deduct it, and we get an answer of $215,170, which is the company's calculated profit.
That's easy, right? Well done. Calculating profit is an important and the first step of any enterprise. But you will also understand why it is important for an entrepreneur to be able to estimate how profitable the enterprise is likely to be in the future. For this, the entrepreneur should draw up what we call a cash flow focused. Our second learning objective for this lesson, it is for you to understand the purpose of focusing of a cash flow and the method of doing so.
As the term forecast indicates, this is a prediction or estimate of how much cash flow of a business can expect. But just like the weather forecaster or the fortune tellers, this forecast is not simply based on magic or a feeling, but it is a calculated estimate. The forecast is made based on facts, the enterprise finances and performance, and again, also held by a formula. A cash flow forecast, therefore, is defined as a prediction or estimate of possible cash inflow and cash outflow of an enterprise over a period of time. Let's say that again. Cash flow forecast is a prediction or estimate of possible cash inflow and outflow of an enterprise over a period of time. Why do businesses want to predict their cash flow? Well, to plan, of course. Accurate cash flow forecasting helps an enterprise to anticipate their future cash positions. This helps them to avoid overspending and shortages. There are good reasons to anticipate the cash flow situation of an enterprise. But did you hear the term inflow and outflow of cash? Indeed, cash in an enterprise flow in and out. Cash inflow refers to the money that the business receives. Cash outflow refers to the movement of money out of the business. From where does the money flow into the business? And where does it flow out to? Let's look at sources of cash inflow and outflow. Money can come in from debtors, meaning people who owe you money have paid up. It can be a loan paid back to you, bank interest that you have earned, proceeds from sales that you have made, or the sales of fixed assets of the business, or the cash payment that you receive for service provided by your enterprise. These are the main source of cash inflow into an enterprise. Let's look at the cash outflow away from the business. Cash or money flows out of the business when it is spent by the business on buying fixed assets such as warehousing, payment of salaries and wages of staff, payment of debts and loan to creditors, and transport costs.
Viewers, you will remember that we said an enterprise draw up a cash flow forecast in order to plan, to anticipate their future cash positions, whether they will be in red or black by month end, to avoid overspending and struggling with shortages to pay staff, rent and other obligations. There is more reasons why an enterprise draw up a cash flow forecast.
Enterprise also draw up a cash flow forecast especially in order to help the enterprise get out of debt faster, enable more predictable growth of the enterprise, and to help the enterprise stick to agreed debt contracts. The entrepreneur chooses the forecasting period. It can be over 3 or 6 months or even over a year-long period. We will now look at the format of the cash flow forecast. This one is forecasted for 3 months ahead. Remember that we focused on assumptions, but these must be realistic assumptions. We will now go through the procedure for drawing up a cash flow statement step by step. Have a look at the form. In the column on the left, for the cash inflow in the 3 months, you firstly see a balance carried forward. This is the money that was left in the business account from the previous month or year. Here it is months. There are spaces for different inflow of cash and the total cash inflow. And this is the same as with the cash outflow and the total cash outflow. And these are shown in this case over a period of 3 months. Now, let's do a cash flow prediction based on some calculations. Here is the beginning of a cash forecast for 1 year of a business. In this case, we are not using months, but years. There is no cash inflow and no balance carried forward. Why? Because it is the first year to run the enterprise, we do not have any previous balance to carry forward. Now, we have had some cash inflow over the year, so let's put it in. So, as to prepare a prediction of a cash inflow based on this year's trends, we had cash inflow into the capital account of
100,000 Namibia dollar.
Can you see it? And from the sales, it was an inflow of 310,000 Namibian dollars. Now, the balance carried forward would be added to cash inflow to determine the total cash inflow. In this case, there was no balance carried forward, so the total cash inflow
for 100,000 Namibia dollar
plus the 310,000 Namibian dollars, which adds up to 410,000 Namibian dollars. Getting interesting, right? Now that we have our total cash inflow, it's time to plot in our cash outflow. Let us assume that our cash outflow was due to salary amounting to 32,000 Namibian dollars, payment of rent of 20,000 Namibian dollar, and transport cost, which totaled 10,000 Namibian dollars. We add up all this cash outflow and we get a total of 62,000 Namibian dollars. Not hard, right? Finally, we have to calculate how much will be left in our business account. Easy, easy, easy. We subtract our cash outflow from our cash inflow, meaning we subtract 62,000 Namibian dollars from 410,000 Namibian dollars. And we get a balance of 348,000 Namibian dollars. Now, we have a full focus for year 1. Very good. Stay with me. Let's move on to year 2. The closing balance of year 1 is now our balance carried forward in year 2. Now we continue to input cash inflow and outflow as we have done with year 1. Inflows were income that comes from sales and from bank interest received, and it was 231,000 Namibian dollars from sales and $11,020 in bank interest received. It gives us a total of cash inflow of $242,020. Now, input these in your cash flow statement under year 2. Here are your cash inflow for year 2 as indicated. Do you see? Now, we do the same with the expenses of year 2 because they are your cash outflow. Expenses included insurance payment of $150, cleaning material cost of $1,500, salaries amounting to $20,000, telephone expenses of $2,200, water and electricity was 3,000 Namibian dollars. So this gives us a total of outflow for year 2 of 26,850 Namibian dollars. Let's input this also on the cash flow statement. Again, in order to make the cash flow prediction, we must deduct the outflows or expenses from our inflows or income. In other words, Total cash inflow for year 2 was 215,170 Namibian dollars. We see that although the balance in year 1 was almost twice as much as in year 2, the cash outflow was also less by about a third. The entrepreneur can also see why the expenses were different in year 2. There was no capital inflow in year 2 compared to over $100,000 of it in year 1. And sales in year 2 were far less. These facts will help the entrepreneur to plan for year 3, perhaps to sell more products and to save on utilities like the telephone and water and electricity costs.
Dear viewers, you now know that you can use a formula to calculate a profit of any enterprise. You also know what a cash flow forecast is and why it is done in an enterprise. You should now be able to represent any financial data on a graph or tables as well. Let's sum up what we have covered in today's lesson. Profit is the money left after paying for all the business expenses. The formula to calculate profit is income minus expenses. A cash flow forecast is a prediction of possible cash inflow and outflow of an enterprise over a period of time. An accurate cash flow forecast helps enterprises to predict future cash positions. This helps them to avoid overspending and shortages. Closing balance of the month or a year is carried over to the next month or a year as balance brought forward. We still have 2 lessons on different topics in Entrepreneurship for AS learners, and we hope you will join us for them. Looking forward to speaking to you again soon. Bye-bye.